Hello, everyone. This is Dr. Duru with Ahan Analytics and the market breadth. Okay, let's start our market discussion with the typical snapshot in time. So we have a bookmark of what's going on. This is actually relatively new. I didn't see this before jumping onto the video, but this consideration of relief for car companies basically underlines and emphasizes and reinforces for us that whatever the tariff policy might happen to be one given day, it may not be the next day. And based on the small moves I saw with the car companies, it seems like the market is starting to get used to all this chaos and volatility in policy. But again, we can never know when the market will decide to jump big or drop big on the next change in tariff policy. So this just means in our trading and our investing, we just have to just as a matter of just reality, just know that this is constantly going to be in the background as long as these tariffs are in place. Actually, and even if all the tariffs were to go away tomorrow, they could come all back the next day. So maybe it's more accurate to say that's just the reality we're living in right now. There's some important headlines I just want to call out before we move on to the charts here. This is disappointing to see. I don't own this stock, Applied Digital. In fact, I just learned about it. But they are saying clients are delaying renewing data center leases. This is a part of the mosaic of uncertainty that's descending upon the economy right now. And I'm worried that some stocks that I have, like Vertiv, that are all about AI data center technology, will get hurt at some point if this is a growing trend. And of course, the big news for today is that Apple and other electronics companies jumped on Monday because guess what? There was yet another change in tariff policy over the weekend that suggests that there will be relief coming for electronics company. I wrote about this in my last blog, where you can find it at drduru.com/122. All right. Well, we did have some important changes in market breadth. Market breadth is the percentage of stocks trading above their 50-day moving averages. I call it AT50. You can find it on TradingView at MMFI. So you can see here that we had another good improvement in market breadth. So this is all very constructive. 3 out of the last 4 days have been big improvements in market breadth. We're still oversold. This is the eighth day of being oversold. So we also have that pressure working down on the market that says that the longer we stay in oversold conditions, the more bearish the overall picture is for the index. And let's take a look at the M10, MMTH, or what I call AT200, or above the 200, to see where we are on the breadth for that calculates longer term health. And you can see here we did not quite make a new high above last week's high. So that means that market breadth improvement is a little bit in question. But I'm going to assume it's going to continue to move higher just because AT50 is moving higher. Okay, let's go back to logarithmic view so we can take a look at the indices with the right perspective. This is the S&P 500. It gained 0.8%. It did fade off of the highs. That's important to note because buyers stopped right at the close of last week's big surge. And also, even more importantly, let me stretch this out. The S&P 500 is going to have a tough time battling this 20-day declining 20-day moving average, given all of the buying that's already happened back here. We have to imagine, particularly given today's reaction to the electronics tariff relief, that buyers are getting a little tired, and it's going to be hard for them to push through this resistance. And then another important thing to note here is I talked about last week how to. Well, let me take a step back. In with this candle here, I guessed that the market was already getting extremely oversold. And on Monday, it got even more oversold. And then I found some green shoots and I said, hey, this looks like a sustainable low. Again, I wrote about this on my blog. And but the market gapped up and I thought I missed out. But what I did was I placed some limit orders around halfway between previous day's close and that day's open on individual stocks, not on the indices. And that ended up working out very well because even though some of the stocks I had continued to sell off for that day, the next day, of course, was a huge historic up day. And all but one or two of those stocks that I bought had basically gave a year's worth of gains in one day, and I took profits. So I followed that same rule today, but note that it's not as attractive to do it way up here as it was way down here, closer to extreme oversold conditions. Where we are now is we're almost about to leave oversold conditions. And so buying is not quite as attractive for short-term trades. Again, particularly because of the the overhead resistance levels. And I'll just point out one more time that this line right here, which is around 55.06, is going to be really tough to break as well. This was a clean breakdown here. On last week's big surge, it stopped just short of that line again. So this is becoming a very important line. And if this line ever does break, then this box is going to be another frame of reference that I'll use for upside resistance, overhead resistance. Okay, let's go to the NASDAQ, which has been performing relatively worse than the S&P 500 on technical basis. Note that last week it dipped below the 20% conventional definition of a bear market. It even dipped below its former all-time high from 2021. So it was looking really bad last week. Now, the surge and rebound has now taken the NASDAQ all the way back to the 20-day moving average. But here you can see what I was talking about, which is this line is going to probably act like tough resistance, and the NASDAQ has already run into this. So if you're looking at individual stock charts, you're going to see a lot of stocks then that did this same thing, run into the 20-day moving average as resistance and then faded. I went ahead and got a calendar call spread on the QQQs, again, waiting for a pullback from the gap open before I open that position. And then there's the small caps, which, I've put on ice because I just expect it to just bounce around between these lines, which define my presumed trading range. The pre-pandemic high as the low part of the range, and the bear market line, which is the high part of the range. So I wasn't even looking at IWM today for any kind of trades. Now, there is despite some of the ominous resistance that's waiting for the indices, at least the VIX is acting as I would like. It plunged even more today, and this pretty much confirms we are on a downtrend from the extreme fear that was in the VIX last week, and particularly on Friday, April 4th. So this day here was the big plunge, the big implosion that I look for. The next day did not give me the follow through. The next day did not give us the follow through, even though it faded from its highs. Today was finally the follow through. Now, this doesn't mean that the VIX is going to keep going down, but I just expect it to trend downward. Even if we get some more spikes, I think that there will become a downtrend line that will guide this thing lower, hopefully back to at least 20 if we're trading from the long side. Okay. So now let's take a look at what I wanted to make sure to point out is I wrote this article on Seeking Alpha called "A Rare Signal Suggests a Final Market Bottom is Not Here Yet." I used a signal that I call the 200-day moving average signal. I encourage you to read that on Seeking Alpha. I will post a link in the video description so you can get it there. And then another thing I was talking about earlier today, this is from my blog, again, drduru.com/122. And I'll put a link to this as well, to my last post. And this is the chart I was talking about, which says this is basically the duration of the oversold period, number of days on the x-axis. And this is the percent change in the S&P 500 over the oversold period. So once oversold, the clock starts ticking once AT50 drops into oversold trading, and then the clock stops once AT50 gets out of oversold conditions. And the history is pretty clear. This is a rough trend line that the longer we stay in oversold conditions, the more likely it is the S&P 500 is going to have a negative performance once it comes out of oversold conditions, which means that it gets harder and harder to expect positive gains just from the oversold period ending. And then we'll have to wait longer to get that positive gain. So we're on the 8th day. So let's mark that off. 1, 2, 3, 4, 5, 6, 7, 8. So we are right here. And you can see that we're almost close to flat, basically. So the S&P 500, once it gets out of the oversold period, we can roughly expect it to be flat. But it's also, this makes it a historic oversold period because there aren't that many other oversold periods in history. And I think I measured this from the starting in 1950, 1951, that have been oversold. In fact, let's count them off. There's 1, 2, 3, 4, 5, 6, 7, 8, 9, only 9 other oversold periods that have lasted longer than the current one. So we are now in new historic extreme territory. I don't like these because it means that I have to be, we, however you want to look at it, have to be braced for basically disappointment, essentially. That this oversold period could just keep dragging on and on. And of course, we have the macro conditions that could cause oversold conditions to continue. One, we have earnings coming up where companies are not likely to provide guidance and they're more likely to disappoint investors than not. And that's because of this just general uncertainty and economic chaos that's swirling around the markets and swirling around the macroeconomics of the US and the globe. And that's just the reality that we live in. So we have to be very measured in our expectations. We also have to trade with risk top of mind and keep those investment horizons top of mind as well. So just as a reminder, I'm not giving any investment or trading advice, just giving information for educational purposes. And hopefully you can apply this in the style of trading and investing that you like. Okay, so if you have any questions or comments or feedback, put them down in the captions. In the captions, in the comment section. Subscribe to this videos to my YouTube channel if you want more timely alerts on this content. And of course, you can always go to the blog at drdrew.com/122 and subscribe there if you want to get more details about these trading techniques and technicals. All right, thanks for checking this out, and I will talk to you later.